while the public was distracted by the headlines and price charts. The banking system quietly hit a hard wall as the net stable funding ratio rules silently reshaped balance sheets across the globe, leaving liquidity vanishing in ways that will shock the market once the scope is fully understood. Because the regulators did not announce it and the media cannot explain it in simple terms. But the desks inside the major banks already know that paper leverage is now a liability rather than an asset. And as overnight funding costs soared, every desk scrambled to adjust positions to comply with the NSFR mandates, forcing Treasury operations to reprice, forcing capital allocations to shift, and creating a vacuum where liquidity should have been, as the very instruments that were once used to lubricate the system suddenly became too expensive to hold. Compelling banks to cover shorts they never wanted to touch, forcing margin calls, forcing risk committees to intervene, and forcing asset managers to reconsider all positions in silver, gold, treasuries, and cash, because every unit of capital now carries a cost that was invisible just days ago. And as the market recalibrates, the public will feel the shock as withdrawal limits, repo lines, and funding windows tighten. Because the NSFR wall does not forgive, it punishes, and as banks exit risky positions, there is nothing left to provide liquidity for normal operations, meaning the usual flow of money into corporate accounts, retail transactions, and interbank loans is suddenly slowed, stressed, and at risk of stalling entirely. Which explains why overnight markets are already seeing spreads widen, why bids are missing, why ask sizes are collapsing, and why traders who thought they were safe are now scrambling for cover, as they realize that Basel III is no longer a distant regulatory threat, but a hard reality that forces the system to honor capital buffers, to respect liquidity coverage, and to price physical metal over paper promises, forcing gold and silver to reclaim status as Tier 1 assets, forcing banks to hoard rather than lend, forcing industrial users to compete for supplies that were once abundant, and forcing investors who rely on paper positions to face the risk of being left empty-handed while the banks consolidate control of physical inventory. Which is why prices are already rising even before the media reports anything. Because the real game is hidden in the regulatory plumbing that most people do not understand. In the capital calculations that determine which banks can survive and which are exposed. And in the NSFR ratios that have suddenly made liquidity a scarce and valuable commodity. And as hedge funds realize they can no longer lever cheaply, as prime brokers tighten their lending, as margin calls hit, and as short positions unwind, the market is entering a phase of forced discovery where the system itself dictates prices, where the rush to comply drives buying and selling irrespective of speculation, where physical metal demand overtakes paper, where retail participants are left behind while institutions align their balance sheets with the new rules, and where every transaction becomes a signal, a warning, and a confirmation that the era of cheap paper leverage is over. Because the NSFR wall does not negotiate. It enforces, it compels, and it reshapes the very architecture of banking liquidity across the globe, leaving nothing untouched, forcing central banks, commercial banks, sovereign wealth funds, and industrial users to rethink priorities, forcing collateral to be physical rather than notional, forcing silver and gold to become scarce as banks scramble to hold, forcing an environment where liquidity is no longer abundant, forcing margins to widen, forcing spreads to blow out, forcing overnight markets into chaos, forcing everyone who ignored the rules to confront reality, forcing the public to witness the limits of the paper system, forcing a recalibration of risk models, forcing pricing to reflect physical constraints, forcing the ultimate recognition that Black Monday is not a date, it is a condition. It is a state of the system under stress. It is the moment when liquidity disappears, when the NSFR wall is hit, when banks must act or fail, when the dominoes begin to fall, when hedge funds are squeezed, when short positions are covered, when the paper game ends and the physical game begins, And while the mainstream news will talk vaguely about volatility, market shocks, or systemic risk, they will never convey the urgency, the immediacy, or the magnitude of the forces at play, because the real story is hidden in spreadsheets, risk models, and compliance memos that dictate how liquidity can flow, what assets can be used, and which banks are permitted to lend, and as the days progress, as the rules are enforced. As the system recalibrates, there will be a visible effect on prices, spreads, and availability of physical metals. Because the NSFR wall is not theoretical, it is operational. It is being executed now. And those who understand the rules, those who see the shortage of liquidity coming, those who follow the mechanics of Basel III rather than headlines, will position themselves ahead of the market, will align with the banks, will secure the physical metal, will protect purchasing power, and will witness firsthand the collapse of paper dominance, as Black Monday is no longer just a concept, it is reality. And the system's liquidity has already begun to evaporate, leaving the unprepared scrambling, the overleveraged exposed, and the physical holders ready to benefit as the new hierarchy of capital takes hold. And as this domino effect continues, the banks forced buying, the shorts forced covering, the industrial scramble for supply, and the forward pricing of physical metal will combine to create a market shock that is inevitable, unavoidable, and absolute, leaving no room for hesitation, and cementing the lesson that when liquidity disappears against the NSFR wall, the market will follow the rules, not opinions, and those who understand the mechanics will survive, while those who do not will be left behind, witnessing a systemic shift that changes the game for gold, silver, and every financial instrument tied to liquidity, leverage, and regulatory compliance. And as institutions act, the retail market feels the pressure as dealers suspend allocations, as vaults drain, as availability tightens, as panic spreads quietly through the system. As spreads widen, and as the rules of Basel III enforce a new hierarchy where physical metal is king, liquidity is precious, leverage is costly, and Black Monday becomes the measure of systemic compliance, forcing every participant to adjust, adapt, and align, or risk being left out entirely. And this is only the beginning of the cascade, the domino sequence that will redefine liquidity, capital, and physical metal allocation for the months to come. And as the market reacts, the nervous, the uninformed, and the late movers will face the reality that the NSFR wall is absolute, inescapable, and unavoidable, while the informed, the prepared, and the aligned will navigate the turbulence, secure their holdings, and witness the transformation of the system as liquidity evaporates. Physical metal is prioritized. Banks cover shorts, industrial users compete, and the paper system collapses under the weight of the new rules, creating the conditions for a historic reshaping of the financial landscape, leaving no aspect untouched, no participant untested, no metal unclaimed, no liquidity unlocated, and no market unchanged in the wake of the NSFR wall being hit and Black Monday arriving in force. Not as a date, but as a structural reality of the banking system today. As the banks struggle to meet the new NSFR requirements, every ounce of physical metal becomes more valuable than paper promises. Vaults drain faster than expected, and the scramble to secure allocations intensifies, with central banks, hedge funds, sovereign wealth funds, and industrial users all moving preemptively to acquire physical gold and silver before normal supply chains can respond, creating a situation where panic buying drives prices higher. Short positions are covered at extreme cost, and the market begins to understand that the era of cheap paper leverage is over, forcing institutions to realign balance sheets, adjust collateral, meet new capital charges, and comply with regulations that are absolute rather than theoretical, while hedge funds that relied on leveraged positions are forced to liquidate. Commercial banks must cover, and prime brokers tighten lending, creating cascading effects across overnight funding markets, repo lines, and interbank credit facilities, which in turn forces spreads wider, liquidity to evaporate, and normal trading activity to slow dramatically, leaving retail participants scrambling to keep up as they watch allocations disappear, vaults deplete, and availability tighten. While the true mechanics of Basel III and the NSFR rules dictate who survives and who is exposed, with physical metal becoming the anchor for the system, replacing the false security of leveraged paper positions while short covering. Forced buying, industrial demand, and sovereign positioning converge to create a perfect storm that drives prices ever higher, liquidity ever scarcer, and uncertainty ever more palpable, because this structural reset is not temporary, it is enforced, and it impacts every layer of the financial system simultaneously, forcing banks to prioritize regulatory compliance over market participation, causing hedge funds to unwind at a premium, pushing industrial users to compete for scarce supplies, and leaving retail investors at risk of being priced out. All while media coverage remains superficial, focusing on volatility, market swings, and panic, without revealing the systemic pressure, regulatory enforcement, and structural changes that are driving the market, which means those who understand the NSFR implications, Basel III enforcement, and the mechanics of liquidity, scarcity, can act ahead of the curve, securing physical metal, adjusting portfolios, and avoiding forced liquidations, while those who ignore or misunderstand are left scrambling, forced to react, and ultimately exposed, creating a market where the value of physical gold and silver rises dramatically against paper claims, where every action is magnified, where the competition for scarce resources intensifies, and where Black Monday is not just a theoretical concept, but a lived reality, dictating price, allocation, leverage, and survival in real time as the domino effect propagates from banks to hedge funds, industrial users, and retail investors, leaving no market participant untouched, forcing all to confront the hard limits imposed by NSFR rules. As capital reallocation, regulatory compliance, and physical metal demand converge to create a new hierarchy in which liquidity is scarce, leverage is expensive, physical assets dominate, and the paper system is subordinated, marking a decisive shift in market dynamics that rewards preparation and understanding while punishing over-leverage, ignorance, and delay, and, as the days unfold, forced buying, short covering, industrial competition, and sovereign positioning will continue to intensify, leading to record premiums on physical metal, drained vaults, and markets that are priced by scarcity and regulation rather than speculation, illustrating that Black Monday is not merely a single day of panic, but an ongoing structural condition in which NSFR compliance, Basel III enforcement, and liquidity constraints dominate every market action, dictating who can trade, who can access capital, who can secure physical metal, and who is left exposed to price shocks, margin calls, and supply shortages, making it clear that the rules have changed. The system has shifted, the paper era has ended, and physical metal is now the ultimate determinant of survival, control, and profit, while liquidity has become a precious and scarce commodity. Spreads have widened, margin calls have multiplied, and the true cost of leverage has skyrocketed, forcing all participants, from banks to hedge funds to industrial users to retail investors, to confront reality, act decisively, and align with the new hierarchy dictated by regulation, scarcity, and physical possession, as every transaction reflects the urgency of compliance, the scarcity of supply, the cost of leverage, and the dominance of physical assets, leaving no aspect of the banking system, financial markets, or metals allocation untouched, creating a scenario where those who follow the mechanics rather than the headlines will prosper. Those who ignore them will suffer, and Black Monday becomes the measuring stick of liquidity, leverage, compliance, and physical metal supremacy across the system, forcing a permanent recalibration in which banks cover, hedge funds unwind, industrial users compete, and retail participants scramble, with physical metal prices rising sharply, paper positions devalued, and liquidity scarcity reshaping market dynamics, reinforcing that the era of unconstrained paper leverage is over. The NSFR wall is absolute. And Black Monday is no longer just a concept, but a reality that dictates market behavior, price discovery, capital allocation, and survival across all levels of finance. As forced buying, covering, competition, and scarcity converge to create conditions where only the prepared, the aligned, and the informed can navigate successfully, while the unprepared are left exposed, reinforcing that physical metal, regulatory compliance, and liquidity management are now the primary determinants of market success, control, and protection, solidifying a new era where Black Monday is defined by systemic pressure, scarcity, compliance, and physical metal dominance, shaping the future of liquidity, leverage, and financial hierarchy for months and years to come, leaving no participant unaffected, no allocation unchallenged, and no market untouched by the structural forces unleashed by the NSFR wall and Basel III enforcement, making physical gold and silver the ultimate anchors of survival, wealth preservation, and strategic advantage, and signaling that the era of paper dominance has ended, replaced by a market dictated by regulation, scarcity, and compliance, in which every action, transaction, and decision must account for the reality of Black Monday. Liquidity, scarcity, and the inexorable rise of physical assets as the cornerstone of the financial system.